To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Let's have a look at another question. Company P has both ordinary shares and equity classified preference shares in issue. So, they have a preference shares which are classified as equity for the purpose of your financial instruments reporting. The reconciliation of the number of shares during year 1 is given below. Balance, opening balance 30 lakhs ordinary shares, 5 lakh treasury shares. Treasury shares are what? Shares which are held by the company. Their own equity shares, they are held by the company. So, what are the number of shares outstanding actually? 30 lakhs minus 5 lakhs, it is only 25 lakhs. Then, bonus issue 5%. So, they have issued 5% bonus on this, which is 1 lakh 50. So, on treasury shares, normally you don't issue bonus shares. So, out of the total, you will only consider the net amount, which is 1.25. Now, please remember, bonus for the purpose of calculating weighted average, you will consider them to be outstanding from the beginning of the period, right? That's what you have learned in Ind AS 33. Then, repurchase of shares for cash. So, they have purchased back shares. So, from the opening balance, you will reduce this 2 lakhs from 1st of May for the purpose of weighted average calculation. 1st of November, issued shares 4 lakhs. So, basically, with this table, you have to calculate the weighted average number of shares which are outstanding, right? Let's look at the additional information. The following additional information is relevant for year 1. Number 1, company P's net profit is 46 lakhs. So, they have given net profit 46 lakhs. Is this the same as earnings available to the shareholders? No, this is only the profit, right? Then, on 15th February, non-cumulative preference dividends of 1.2 per share were declared. So, preference shares, whatever they have here, you can see preference shares of 5 lakhs. On this, 1.2 per share has been declared. They are not cumulative, they are non-cumulative. Now, when you are calculating earnings per share, you will reduce this particular dividend, right? Then, the dividends were paid on 15th of March, it's okay. Preference shares do not participate in additional dividends with ordinary shares. So, whatever they are entitled to is only 1.2. So, what do you do normally? You take net profit minus preference dividends, you get earnings available for equity shareholders, right? Dividends on non-cumulative preference shares are deductible for tax purposes. Okay, so this doesn't seem to be a scenario from India, but they are deductible for tax purposes. Means if you pay 1.2 of dividend, you get 30% tax benefit. So, what you will do? Net profit minus preference dividend. This preference dividend will be net of tax, because you are paying preference dividend, you will save tax also. So, 1.2 into 5 lakhs is how much? 6 lakhs. There is an outflow of 6 lakhs. There is a dividend to be paid of 6 lakhs. But then on this 30%, that is 1.8 lakhs will be your tax savings. So, this 1.8 lakh will actually increase the earnings available to the shareholders. This will be added back. The financial year of the company ends on 31st of March. This is given because you need to calculate the weighted average number of shares. So, what are you required to do? Determine the basic EPS of the company for the year 1. Use number of months or part of months rather than number of days in calculation of EPS. So, you need to calculate the EPS. Very, very simple question. So, with this numbers, let us start our calculation. First is to calculate weighted average number of equity shares. So, we will begin with 1st of April. Number of shares outstanding, how many are given? 30 lakhs minus 5 lakhs. So, 30 lakhs minus 5 lakhs, you have 25 lakhs. Okay. Then, next issue happened on 15th of April. Now, if something has happened on 15th of April, which is bonus issue, you will take it as if it is outstanding for the full period, right? So, whatever is the bonus issue that has happened, that also will be considered as if it is outstanding from 1st of April. Okay. So, on 15th of April, so what I can do is particulars, opening 25 lakhs, bonus, how much is the bonus? 5%, which we have calculated it to be 1.25 lakhs, so 1,25,000, right? Then repurchase of shares. So, 1st of May repurchase minus 2 lakhs minus 2 lakhs. Then Shares issued for cash 1st of November. How much is the shares issued? 4 lakhs. Right. So, these are the various movements. Now, what you need to do? You need to calculate the weights and weighted average. Right. There are two ways to do. We will solve it in both the ways. For opening balance, it's outstanding for 12 months. So, the weight is 12 out of 12. For bonus issue also, it's for the full period 12 out of 12. Repurchase happened on 1st of May. So, when repurchased happened on 1st of May, it will be given effect for 11 months. So, 11 out of 12. May till March, and 1st of November, December, January, February, March. So, 5 months. So, 5 out of 12. So, what is the weighted average? 25 multiplied by 1. Here also multiplied by 1. Minus 2 multiplied by 11 divided by 12. You get 1833,333.33. 18, it gives you 1,83,333, and 4 multiplied by 5 divided by 12. You get 1,66,666, right. So, what is the total weighted average? Sum of all of this, you get 26,08,333, right. That is one way to do. The other way to do is cumulative. So, here 1st April 25 lakhs, when does the next change happen? The next change happened on 15th of April, but this is also effective from 1st of April. So, the next change actually happens on 1st of May. So, here cumulative is 26,25,000. Number of months before the next change is 1. Then on 1st of May there is a repurchase, which means 2625 minus 2 lakhs. So, you have 24,25,000. Number of months this is outstanding, or the change is effective, is from May, June, July, August, September, October. So, 6 months. Then lastly, 2425 plus 4, 2425 plus 4 lakhs, 2825, and November, December, January, February, March, 5 months. So, what is the weighted average? Weighted average is 2625 into 1 divided by 12. Then this multiplied by 6 divided by 12, and this multiplied by 5 divided by 12. And if you sum this up, you get 26,08,333. Either ways you can do, right. So, then weighted average number of shares is done. Now, we need to calculate earnings available to shareholders. Now, what is the earnings available to shareholders? The earnings available to shareholders is net profit as given. How much is the net profit given? 46 lakhs. Then, less preference dividend 6 lakhs, add tax savings on preference dividend 30%. So, this multiplied by 30%, which is 1,80,000. So, earnings available to equity shareholders is 46 minus 6 plus 1.8, you get 41,80,000. So, what is EPS? EPS is EAESH divided by weighted average number of equity shares, which is 4180, and here it is 2608. So, the EPS is 4180 divided by 2608, you get 1.602, you get 1.602 or 1.60 per share. Let us look at the next question. In year 3-4, after the entity's 31st March year 3 annual financial statements were approved for issue. So, it has been approved for issue. A latent defect in the composition of a new product manufactured by the entity was discovered. That is, defect that was not discoverable by reasonable or customary inspection. Latent means something which is hidden. Okay. So, normally if you would have seen, you would not have been able to realize the defect. As a result of the latent defect, the entity incurred rupees 1 lakh in unanticipated cost for fulfilling its warranty obligation in respect of sales made before 31st of March. An additional 20,000 was incurred to rectify the latent defect in products sold during year 3, year 4 before the defect was detected and the production process was rectified. 5,000 of which relates to items of inventory at 31st of March year 3. The defective inventory was reported at cost of 15,000 in the financial statement of year 2, year 3, when its selling price less cost to complete the sale was estimated to be 18,000. So, this was estimated to be the NRV. The accounting estimates made in preparing the 31st March year 3 financial statements were appropriately made using all reliable information that the entity could have reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial statements. Analyze the above situation in accordance with Ind AS 8. Now here 2-3 things important to understand. First is whether it is a prior period error or not. Okay. Now here if you see, the defect could not have been discovered by reasonable or customary inspection. Normally if you would have inspected, you would not have got it, right? So that is the first part. Second important part is, this is year 3, year 4 after the entity's annual financial statements were approved for issue. So if you see, this is year 2, year 3, and here let us say financial statements issued. This is year 3, year 4, and here is somewhere you discovered the error. So after the financial statements, you have discovered that, okay, you need additional provisions. You discovered that inventory is not stated properly. Can you go back and change? You cannot change. These are subsequent events which have occurred after the financial statements have been issued. That is the first thing. Second, while preparing the financial statements, certain estimates were made, and the question says that the accounting estimates made in preparing the March 3 financial statements were appropriately made using all reliable information that the entity could have reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial statements. Means whatever information was available, whatever items were available, considering that estimates were made. So this is not an item of prior period error. And second, because it has happened after the issue of financial statements, you cannot go back and change the 31st March year 3 financial figures, right? So where will the impact come? All this impact will be, shown in the year 3, year 4 financial statements. So let's have a look at it, how the solution is to be presented. The defect was neither known nor reasonably possible to detect at 31st March or before the financial statements were approved for issue. Hence, 1 lakh understatement of warranty provision and 2000 of overstatement of inventory. Why overstatement of inventory? Inventory was reported at cost 15,000 now, and 5,000 additional was incurred to rectify. Means from your NRV less cost to sell, which is 18,000, you will still have to incur another 5,000, which makes it 13,000. This becomes your NRV. How much is the cost? 15. So you should have reported at 13,000. Now you have reported it at 15,000, which is 2,000 excess. Can I go back and change year 3 financials? I cannot change. I have to report this in year 3, year 4 financials only. So understatement of warranty provision and 2,000 overstatement of inventory in 31st March year 3 financial statement is not a prior period error. It is not a prior period error. The effect of latent defect that relate to the entity's financial position at 31st March are changes in accounting estimates, because you have done certain estimates. You have taken all the information that is possible, that is available on the date of financial statement, and you have prepared it. In preparing its year 3 financial statement, the entity made the warranty provision and inventory valuation appropriately, using all reliable information that the entity could reasonably be expected to have obtained and taken into account. Consequently, the additional cost will be expensed in calculating profit or loss for year 3, year 4. In an arm's length transaction, entity X buys 10,000 convertible preference shares in a company Z for cash payments of 40,000 with 25 payable immediately and 15,000 payable in 2 years. Market rate of annual interest for a 2-year loan to the entity would be 6%. So you are paying 25,000 today on year 0 and you are paying 15,000 at the end of year 2. This 15,000 you will discount back at 6% and take this amount back to year 0. So how will you account for it? The accounting will be present value of 15,000, that is 15,000 divided by 1.06 divided by 1.06. If I do it, I get 13,350. So 25,000 plus 13,350 is your value at which you will record the financial instrument. Since the payment of 15,000 is deferred for 2 years, the fair value of the consideration given for the shares equal to 25,000 plus the present value of 15,000, which is 13,350. And because the transaction took place at arm's length, this is 38,350 is what is the fair value. Now what about the extra amount paid? Extra amount of 1650 will be recognized as interest expense in P&L over the 2-year period. Let's have a look at the next one. This is based on Ind AS 24 and 109, financial instrument and related parties. SCL had applied for a term loan from a bank for business purpose. So SCL is the entity. There is a bank. As per the loan agreement, the loan required a personal guarantee of one of the directors. So SCL has some director, and this director will give what? A guarantee. SCL is not giving guarantee. SCL is getting a benefit under the guarantee. In case of default by SCL, the director will be required to compensate for the loss that the bank occurs. So if bank occurs any loss, the director will compensate. Mr. Purejoy, one of the directors, had given guarantee to the bank pursuant to which the loan was sanctioned to SCL. Okay, so one director has given the guarantee. SCL does not pay premium or fees to its director. Now, normally what happens is, if you ask someone to give a guarantee, for example, if there is a bank, you are a vendor and there is a customer. Okay. Now the customer says that I cannot trust you. If there is financial loss, we will make good. So what the vendor does is, vendor goes to this bank and says, why don't you give a guarantee to the customer that I will perform, and if at all there is a loss, you will compensate the loss. Now bank can give that guarantee based on the credit worthiness of the vendor, the limits and all of that, but the bank will not do it for free. Bank will charge some percentage as commission. Here director is giving the guarantee, but director is not charging anything. Okay. Whether SCL is required to account for the financial guarantee received from its director, will there be any disclosure? Now, first thing is what is a financial guarantee? Financial guarantee is a contract where one party agrees to compensate the loss incurred by another party in case of a default, right? That is the definition of a financial guarantee. Is it a financial guarantee? Yes, there is a loan involved and the loss will be compensated in case of default. So, it's a financial guarantee. Now, is SCL required to account for it? See, if the entity had paid some percentage as commission or some amount as commission, then you would have accounted for it as commission respectively. You would have taken it as commission or expense and you would have accounted for it. Now here, because nothing is paid, then there is no need to account for it. There is no need to account for it because there is no expense that is being incurred. Then will there be any disclosures under Ind AS 24? Yes, as per related party, the disclosures have to be given, and as per related party, disclosures have to be given. Let us see what are the disclosures required. You will have to disclose the amount of transaction, basically the amount of guaranteed amount, the amount of outstanding balances including commitments, the terms, conditions and all of that, details of guarantee received. C and D are not needed in this particular scenario because there is nothing which is outstanding. Okay, so though the RTP solution says expense recognized during the period in respect of bad and doubtful debts from related party, it is not a debt from a related party. It is a guarantee given by a related party, right? So that declaration, disclosure is not required. So basically, we will disclose what are the transactions, what is the balances, if any amount has been paid, that has to be disclosed, and what are the details of guarantees which have been received from the particular director. Let's look at the next question. An entity acquired two trade secrets, secret recipe in a business combination. Recipe A is patented, recipe B is not legally protected. So there is one patented recipe, there is a non-patented or not protected recipe. How the acquisition of recipe A and recipe B would be accounted for by the entity as per relevant Ind AS. Now here there is business combination 103 and also 38 intangible asset. Now when it comes to intangible assets has to be identifiable. For it to be identifiable, you must either be able to separate and sell, or it arises from contractual arrangements. Right. So in one of these two situations, you say that yes, the intangible asset is identifiable. Only when it is identifiable under Ind AS 38, then you will recognize it as an intangible asset for the purpose of acquisition date accounting. Now, whether it is identifiable as per Ind AS 38 or not, for that what you need to do, you need to see whether it is separable. Now, when is it separable? It is separable when you can separate it and sell it in the business. And otherwise, if it is arising out of a contractual arrangement or is it arising out of legal arrangement, then it becomes identifiable, right? So, recipe A anyways is patented, so because it is protected by law, it has it is protected under a legal right, you can easily sell off the patent, and hence it is identifiable. Recipe B is not protected, but still it is identifiable if it arises from a contractual right. Okay, so in that case, both these meet the criteria of identifiability, and hence you will account for them as intangible assets for acquisition date accounting. So let's have a look at the answer for this. Para 11 and 12, so we can just ignore the para numbers. States that the definition of an intangible asset requires an intangible assets to be identifiable to distinguish from goodwill. Goodwill recognized in a business combination is an asset representing future economic benefits arising from other assets acquired in a business combination that are not individually identified and separately recognized. So something which cannot be separately identified, it gets mixed with the goodwill. This we have already understood. The future economic benefits may result from synergy between identifiable assets acquired or from assets that individually do not qualify for recognition in the financial statement. So there would be some kind of future economic benefits. Further, an asset is identifiable, this is the important part, if it is either separable, that is being capable of being separated or divided from the entity and sold, transferred, licensed, rented, exchanged, etc., or arises from contractual or other legal rights, regardless of whether those rights are transferable or separable from the entity or from other obligations. In this case, entity A meets contractual legal criteria for identification as an intangible asset because it is protected by a patent. The recipe is identified and recognized separately from goodwill. Since recipe B is not protected by a patent, it does not meet the contractual legal criteria for identification. However, recipe B is identified as a separate intangible asset because it meets the separability criteria. Such recipes can be often exchanged, licensed or leased to others, and hence unpatented recipe B should also be accounted for as a separate intangible asset. Next one. The entity's financial year ends on 31st of March. What are the reporting periods for which financial statement, condensed or complete, in the interim financial report of the entity as on 30th of September are required to be presented if the entity publishes interim financial reports quarterly, if the entity publishes interim financial reports half yearly. Now, this is a straightforward thing which we have discussed in the class also. Now, in this question, it's a straightforward thing. If it is published quarterly, means what? We are on 30th of September. Okay, this is one quarter. So for this quarter, what all you need to prepare, right? So when it comes to P&L, 30th September, you will make the P&L for Q2. You will make P&L for YTD 30th of September and also give the comparatives. Balance sheet, what will you do? Balance sheet you will prepare as on 30th of September and you will prepare balance sheet as at the end of the immediately preceding year. So let's have a look at this solution. We also need to prepare statement of changes in equity. All of this we have discussed in the class. So interim period, balance sheet as of the end of the current interim period and a comparative balance sheet as at the end of the immediately preceding financial year. Statement of P&L for the current interim period and cumulatively for current financial year to date with comparative statements of P&L for the interim period and year to date of the immediately preceding period. So P&L you will have 4, right? Then statement of changes in equity cumulatively for the current financial year to date with a comparative statement for the comparable year to date period of the preceding period, and statement of cash flows cumulatively for the current financial year to date with a comparative statement for the comparable year to date period of the immediately preceding year. So what all will you present? Balance sheet as on the date 30th September, 31st of March. Statement of P&L 3 months current period, 3 months comparative, 6 months current year, 6 months comparative. Statement of changes in equity 6 months year end, comparative 6 months. Statement of cash flows 6 months and 6 months, right? Now if it publishes half yearly, now when it publishes half yearly, what would happen is here you will have only 6 months, you will not have anything 3 months, and rest all information would remain the same. Let's look at the next question, pretty elaborate, but if you study it carefully, you will be able to handle it. On 1st of January of year 1, the carrying amounts of the relevant assets of the division of an entity are as follows. Purchase goodwill 1.2 lakhs, PPE average remaining estimated useful life 2 years 4 lakhs, inventory 2 lakhs. Okay, so what are these? These are the carrying amounts. From 1st of January of year 1, Star Limited began actively market the division and has received a number of inquiries. On 1st of January, directors estimated that they would receive 6.4 lakhs from the sale of the division. So this is the value that they would realize in the sell. Since 1st January, market conditions have improved and on 30th of April, Star Limited received and accepted a firm offer to purchase the division for 6.6 lakhs. The sale is expected to be completed on 30th of June. Rupees 6.6 lakhs can be assumed to be a reasonable estimate of the value of the division on 31st of March. So, as on 31st of March, 6.6 lakhs can be estimated or considered to be a reasonable estimate of the amount that would fetch. During the period from 1st of January to 31st of March, inventories of the division costing 1.6 lakhs were sold for 2.4 lakhs. So, whatever inventory were costing 1.6 lakhs, they were sold separately for 2.4 lakhs. At 31st March of year 1, the total cost of the inventories of the division was 1.8 lakhs. So, as in 31st of March, the inventory is 1.8 lakhs. Now, you may think, sir, 2 lakhs, may say we have already sold inventory costing 1.6, how is it 1.8? There could be fresh purchases. All of these inventories have an estimated NRV that is in excess of their cost. So, at least you will get 1.8 lakhs. Explain the disclosure requirement related to sale of division and provide the accounting treatment of property held for sale and discontinued operations. Now, here, in case this is covered by Ind AS 105, we know that deals with non-current asset held for sale and discontinued operation. Now, first, it is a division. So, we can say that this is a part of an operation, a discontinued operation, which has goodwill, PPE and inventory. Now, what is the date? On 1st of January is the date on which they have said that, okay, they begin to actively market. So, on this date, you will classify it under Ind AS 105. On that date, what will you do? You will take the lower of carrying amount and the fair value less cost to sell. Now, what is the carrying amount? 1.2 plus 4 plus 2. 1.2 plus 4 plus 2. This is 7.2. What is the realizable value on that date? Less cost to sell? 6.4. So, 7.2 minus 6.4, you get 0.8 of loss. This loss is impairment loss. This impairment loss is first adjusted against goodwill. Now, what is the goodwill value? Goodwill value is 0.4 lakhs. From 1.2, it has come down to 0.4 lakhs. That is the first thing. Then, subsequently, Star Limited received and accepted a firm offer to purchase the division for 6.6. The value has increased. Now, can I reverse the value? Can I reverse the impairment loss? Please remember, this impairment loss has been allocated to goodwill. So, subsequently, you cannot reverse the impairment loss, right? Now, as at 31st of March, what are the values to be shown? See, PPE is having a value of 4 lakhs. So, you will continue to show it at 4 lakhs because that has not been impaired. You will not depreciate this. So, on 31st of March, PPE will be shown at 4 lakhs. Goodwill will be shown at 0.4 lakhs and inventory will be shown at their cost, which is 1.8 lakhs, right? These assets will be shown separately from the remaining asset, and also the P&L from the discontinued operation will be shown on a post-tax basis as an item on the face of the P&L, right? So, whatever is the profit or loss that has happened from this discontinued operation, that will be shown separately. The decision to offer the division for sale on 1st of January means from that date, the division is classified as held for trade, okay. The division is available for immediate sale and is being actively marketed at a reasonable price, and the sale is expected to be completed within 1 year. The consequence of the classification is that the assets of the division will be measured at lower of their existing carrying amount and their fair value less cost to sell, so 6.4. The reduction in carrying amount of 0.8 lakhs will be treated as impairment loss and will be adjusted against goodwill. Already we have discussed this. Increase in carrying value, increase in expectation of the selling price of 0.2 lakhs will be treated as reversal of impairment loss, but since it is related to goodwill, it cannot be recognized. Assets of the division needs to be presented separately. So, you will present the PPE at 4 lakhs, inventories will be shown at year end cost of 1.8 and the division will be regarded as discontinued operation and it will represent a separate line of business as held for sale. The statement of P&L should disclose as a single item the post-tax profit or loss from the division and the impairment loss arising on the remeasurement of the division. Further analysis of the single amount may be presented in the notes in the statement of P&L. If it is presented in the statement of P&L, it shall be presented in a section identified as relating to discontinued operation, which is separate from the continuing operation. Now, let's have a look at the question on Ind AS 23. LT Limited is in the process of constructing a building. The construction process is expected to take about 18 months from 1st of January. So, 1st of January they started and it will take 18 months. So, of course, a qualifying asset. Till 30th of June of year 2. So, 30th of June of year 2, this is 1st of January of year 1. Okay, so here you have 31st of March of So here you will have 31st of March of year 1, 31st of March of year 2, and then you will have 31st of March of year 3. Okay. The building meets the definition of qualifying asset. LT Limited incurs the following expenditure. 1st of January 5 crores, 30th of June 20 crores, then 20 crores, then 5 crores, 31st of March, 30th of June. On 1st of July of year 1, LT Limited issued 10% redeemable debentures for 50 crores. How much they have spent? They have spent 50 crores and they have issued debentures of 50 crores. The proceeds from the debentures form part of the company's general borrowing. So they have done a general borrowing, it's not a specific borrowing, which it uses to finance the construction of a qualifying asset, the building. So now this 50 crores will be used to finance the construction of building. When did they take? 1st of July the loan is taken. When did the construction start? 1st of January of year 1 the construction started. So from 1st of January till 30th of June of year 1, if you see, there is no borrowing cost being incurred. LT Limited had no borrowings general or specific before 1st of July and did not incur any borrowing cost before that date. LT incurred 25 crores of construction cost before the general borrowing and 25 crores after obtaining the general borrowing. For each of the financial year ended 31st March of year 1, year 2 and year 3, calculate the borrowing cost that LT Limited is permitted to capitalize as a part of building cost. Now, there are multiple things that are happening here. There are multiple things that are happening here. 1st of January is the construction start, and when was the borrowing happened? 1st of July of year 1. So here, somewhere here. 1st of July of year 1, this is when the borrowing happened. Now, any cost before this, there is no question of capitalization because borrowing has not been incurred. Now, we spent 25 crores already out of our own money and then we took the borrowing. Can we capitalize the cost? Now, here, the way to look at this, especially when there is a general borrowing, is that this 25 crores we would have taken or we would have utilized from our existing resources. Now, the building construction is not yet completed. We need money for other purposes also. So, to fund this part, the 25 crores which we have utilized from the general funds, you can think of it that to fund that part, the company has taken a general borrowing. Now, when the company has taken general borrowing, it is funding the WIP which is existing and also future cost. Right. So, from 1st of July, on the proportion of WIP, whatever is there, on that we will capitalize the borrowing cost. Right. So, let us see how do we capitalize the borrowing cost for each of the years in these 3 years. Now, borrowing cost for year ended 31st of March of year 1. Since the company does not have any borrowings, the company cannot capitalize any borrowing cost. Right. Now, for year ended 31st of March of year 2, how should we capitalize? Now, for that, we have to see what are the amounts spent. Now, for year ended 31st March of year 2, you need to capitalize the borrowing cost for 1st of April year 1 till 31st of March of year 2. Now, for this you need the opening balance. 1st of April year 1, what is the WIP? The WIP is, if you see the question, the WIP comes to 5 crores. 30th June is the next spend. So, on 1st of April the opening balance is 5 crores. So, WIP is 5 crores. So, 5 crores. Okay. Now, for this, how many months of interest can we capitalize? See, borrowings we have done on 1st of July. So, you will capitalize the borrowing from 1st of July only. Sir, we have already spent the amount. Yes, we have already spent the amount. Now, subsequently, you are using a general borrowing to fund the construction. So, number of months would be from 1st of July. So, July, August, September, October, November, December, Jan, Feb, March, 9. Interest is 5 multiplied by 9 multiplied by, what is the rate of interest? Rate of interest is 10%. So, 10% divided by 12, you get 0.375. Then, the next spend, if you see, happened on 30th of June. So, for whatever you have spent on 30th of June of year 1, WIP 20 crores. How many months? From 1st of July again, 9 months, interest is 1.5 crores. Then, The next spend happened on 31st of March of year 2. WIP, how much is the amount spent? 20 crores. Number of months 0. Interest will also be 0. So, total interest to be capitalized is 1.875, right? So, interest to be capitalized is 1.875. Now, for year ended 31st of March of year 3. Again, what is the opening balance? 1st of April of year 2, how much is the WIP? Now, amount that is spent till date is 20 plus 20 plus 5, which is 45 crores. Now, please remember, at the year end of 31st March of year 2, we would have capitalized 1.875. So, your amount would be 45 plus 1.875, that makes it 46.875. How many number of months? Now here, if you go back to the question and see, the period of completion is 30th of June of year 2. So, 3 months. 1st of April of year 2, May, June. April, May, June, 3 months. Interest would be 46.875 into 3 divided by 12 multiplied by 10%. You get 1.171875 or 1.17 rounded off. Then, after that 30th of June of year 2, WIP, how much is the spent? 5, number of months 0, interest also is 0. So, in the second year, you will capitalize interest of 1.17 or 1.17, or you can increase the decimal by 1, which is 1.172. Right. So, in year 1, you will capitalize interest of 1.875 and in year 2, you will capitalize interest of 1.172. And in this case, you are not capitalizing more than the borrowing cost because the total borrowing is 50 crores and 10% is that. 10% is what you have been paying. Now, some of you might be wondering, sir, can we add interest to the carrying amount and then calculate the amount on which the capitalization rate has to be applied? And the other thing is, can we capitalize interest on amounts which you have already spent when there was no borrowing? There are two questions, right? There are two issues which can arise from this question. This is an RTP May 23 question and this is slightly tricky as well. Now, for this, what you need to understand is, as far as the amount of expenditure is concerned, what the standard says, as far as the amount of expenditure is concerned, what the standard says is, the amount of expenditure can be your carrying amount plus interest already incurred, right? So, to that extent, you can consider that, okay, this is the amount, this is an approximation of the amount on which the capitalization rate has to be applied. So, if I take you through the specific part which says, the average carrying amount of the asset during a period, including borrowing cost previously capitalized, is normally a reasonable approximation of the expenditure to which the capitalization rate is applied in that period. So, what is a reasonable approximation? The reasonable approximation in this case is, what is the borrowing cost previously capitalized plus what is the average carrying amount of that particular asset, right? So, that is where you can use the carrying amount and the interest already incurred and arrive at the amount to be capitalized. And of course, because we are saying the average carrying amount, you can also do a period weighted thing. So, for example, instead of doing amount into rate into number of months divided by 12, you can also do, on that amount you calculate what is the weighted average. Now, what you can do is, this amount itself you can calculate what is the weighted average. So, what do I mean by that? For example, if you come back to this, here we said 5 crores 9 months and we applied the interest. Instead of that, what you can do? What is the weighted average amount? That is 5 multiplied by 9 divided by 12, 3.75. Then this 15, 20 multiplied by 9 divided by 12, and this 20 multiplied by 0 divided by 12, you get the 18.75. On this, if you apply 10% into 10%, if you do, you get 18.75 into 10%, that is 1.875. Now here, opening balance 46.875, again weighted average amount is 46.875 multiplied by 3 divided by 12. Here 5 multiplied by 0 divided by 12. So, the total you get is 11.719. On this, when you multiply this by 10%, you get this 11.719 into 10%, you get 1.1718 or 1.172, right? So that also is another way to calculate. One is this, what we did here. This is another way where we have used the weighted average amount and then applied the interest rate. Basically the product method, what we call, right? So that is how you will have to handle questions based on general borrowings. When this is spread over different periods, please consider the WIP and also add to that the interest which is already capitalized.